The federal government is $1.8 trillion in the hole this year alone. And right now, the White House is quietly designing a tax break that could hand wealthy investors billions, while asking you to foot the bill. No vote yet. No law yet. Just a plan. Let's talk about it. Here's the headline everywhere this week: Trump is weighing a massive new tax break for investors. Not announcing. Not signing. Weighing. That word matters. We'll come back to it. But here's why you should still care, right now, before anything is official. Because by the time policies like this actually pass, by the time they show up in a press conference with a signature and a pen, the people who benefit most have already positioned themselves. They bought the asset. They restructured the trust. They called the accountant 3 months early. You, watching this video, are getting the information at the exact moment it's still useful. Not after. So here's what's actually on the table. 2 ideas. One is about who pays taxes when they sell a stock. The other is about who pays taxes when they sell a house. Both aimed at investors. Both, according to the people floating them, framed as fairness. And both, if you do the math, and we're going to do the math, mostly help people who already have money working for them. Let's start with the mechanism, because once you understand it, you'll never look at a capital gains headline the same way again. Imagine you bought a stock 10 years ago for $10,000. Today it's worth $20,000. You sell it. In the eyes of the IRS, you made a $10,000 profit. That's your capital gain. That's what gets taxed. Simple, right? Except there's a problem nobody talks about at dinner parties: inflation ate part of that gain before you ever saw a dime of real profit. $10,000 in 2016 doesn't buy what $10,000 buys today. Prices for everything, food, gas, materials, labor, have crept upward year after year. So some of that profit the IRS wants to tax isn't really profit at all. It's just the same value, wearing a bigger price tag. This is the idea behind what's called indexing capital gains to inflation. The proposal being floated in Washington right now would let investors adjust their original purchase price, their cost basis, upward, to account for inflation, before calculating the taxable gain. Suddenly that $10,000 gain might only be, say, $7,000 of real gain. Less profit on paper. Less tax owed. Supporters call this fairness. They say the government shouldn't tax phantom gains that only exist because the dollar shrank. And on paper, that argument isn't crazy. Inflation is real. It does distort numbers. But here's the twist. This idea has been floated before, under multiple administrations, going back decades, and it keeps dying for the same reason. It overwhelmingly benefits people who hold large amounts of appreciating assets over long periods of time. Stocks. Real estate. Business equity. The kind of wealth that compounds quietly in the background while you're not looking. Now add the second idea to the mix, a bigger exemption on capital gains when you sell your primary home. Right now, if you're single and sell your house, the first $250,000 of profit is tax-free. Married couples get $500,000. Those numbers haven't moved since 1997. Home prices, meanwhile, have roughly tripled in many markets since then. So there's a real argument that this exemption is outdated. A homeowner in a hot market today can blow past that limit just from decades of ordinary appreciation, not because they got rich, but because the market moved around them. Put both ideas together, and you get a headline like the one that pulled you into this video: massive tax breaks for investors. Sounds universal. Sounds like it's for everyone. It isn't. And this is where we need to slow down. Let's talk about who actually owns stocks in this country, because this is the part the headlines skip. The wealthiest 10% of American households own the overwhelming majority of stock market wealth. Most credible estimates put it north of 80%. The bottom half of the country, combined, owns a sliver. A rounding error by comparison. So when you index capital gains to inflation, you're not cutting taxes for investors in some broad, democratic sense. You're cutting taxes primarily for the people who already hold the largest, longest-running investment portfolios. The person with a modest 401k contributing steadily out of every paycheck barely feels this. The person sitting on a multi-decade stock position worth 8 figures feels it enormously. Now here's the part that should genuinely bother you, regardless of your politics. This proposal is landing at the exact moment the federal deficit hit $1.8 trillion for the first 10 months of the fiscal year alone. That's not a typo. That's the current fiscal reality, reported by the Congressional Budget Office, while this tax break is being discussed. Think about that timing. The government is spending far more than it's taking in. And one of the ideas being seriously considered is, taking in less, from the people most able to pay. This is the uncomfortable math nobody puts in the thumbnail. Every dollar of tax revenue that doesn't get collected from investment gains has to be made up somewhere. Either through more borrowing, which future taxpayers absorb through interest payments, or through taxes collected elsewhere, from people with far less room to spare. There's also a quieter mechanism buried inside this that deserves a moment of attention, something called a step-up in basis. When someone dies and leaves stock to their heirs, the heirs typically inherit that stock at its current market value, not the original purchase price. All the built-up gain, potentially decades of it, simply vanishes for tax purposes. It's already one of the largest, least discussed tax breaks in the entire code. Now layer inflation indexing on top of that. Analysts have pointed out that wealthy families could use both tools together, donating appreciated stock, adjusting for inflation, holding until death, to compound the benefit even further. It's not illegal. It's not even hidden. It's just quiet. And quiet is exactly how the biggest tax advantages in America tend to work. Nobody's throwing a party about the step-up in basis. It just sits there, doing its job, decade after decade. So we have a proposal marketed as broad relief for investors, arriving during record deficits, that mathematically concentrates its benefit at the top, while a related loophole already lets that same benefit compound across generations. That's not a conspiracy. That's just arithmetic. Now let's go back to that word from the beginning. Weighing. Because here's the reality check this entire topic needs. As of right now, nothing has been signed. Nothing has passed Congress. A White House spokesperson, when asked directly, gave the classic non-answer, that the president is always exploring new ideas, but that any actual policy announcement would come from the administration directly. Translation: this is a trial balloon, not a law. And the timing of that trial balloon is worth noticing. It's landing in the run-up to the midterm elections. Tax breaks framed as help for everyday investors tend to poll well. They sound like empowerment. They sound like your 401k just got a boost. That's a compelling message to float a few months before voters head to the polls, whether or not the policy ever actually clears Congress. There's also real disagreement inside the president's own party. Indexing capital gains to inflation has support from some Republicans, including a caucus of nearly 200 House members. But it does not have universal backing. Some fiscal conservatives look at that same $1.8 trillion deficit and conclude the last thing the country needs is a policy that shrinks tax revenue further, no matter how intellectually defensible the inflation argument sounds on paper. So here's the honest picture, stripped of headline language. This is a real idea, being seriously discussed, by real people with real influence, at a real moment of political motivation, but it is not, today, an actual policy. It could stall in committee. It could get watered down into something far smaller than massive. It could disappear entirely if the political winds shift. Or it could pass in some modified form buried inside a larger bill nobody reads in full. The irony here is almost poetic. A proposal explicitly about accounting for how things change over time, inflation, is itself sitting in a kind of political limbo, where its own fate could change completely by the time you finish watching this video. Step back from the specific mechanics for a second, because there's a larger pattern here worth naming. Over the past several years, we've watched a steady drumbeat of proposals that share a common shape: attractive, broadly worded names, tax cuts, wealth-building accounts, investor relief, that, when you trace the actual dollar flows, concentrate their biggest advantages among people who already have substantial assets. That's not unique to one party or one administration. It's a pattern in how modern tax policy tends to get built, because the people with the resources to lobby for these changes are, unsurprisingly, the people positioned to benefit from them most. None of this means the underlying economic argument is fake. Inflation genuinely does distort capital gains. Outdated home sale exemption limits genuinely do punish ordinary long-term homeowners in expensive markets. These are legitimate problems. But legitimate problems have a way of getting solved through policy designed by, and for, people who are already doing fine, while the compounding cost gets quietly distributed across everyone else, one deficit dollar at a time. And here's the risk that rarely gets airtime: policies like this don't just cost money today. They shape incentives for decades. If holding appreciating assets becomes even more tax-advantaged, the gap between people who own assets and people who don't doesn't just persist, it widens, generation after generation, compounding as quietly and relentlessly as the investments themselves. That's the real story hiding underneath a headline about massive tax breaks for all investors. It was never really about all investors. It's about which investors, how much, and how long the rest of the country ends up carrying the difference. So where does that leave you? Nothing here is law yet. Nothing here is guaranteed. But the direction of travel is worth watching closely, because these ideas rarely disappear entirely, they resurface, get repackaged, and eventually find a vehicle to ride into law when the political timing lines up. If something like this does pass, it will almost certainly be framed, once again, as a win for everyday Americans. And in a narrow, technical sense, some ordinary investors and homeowners genuinely would benefit. That part isn't a lie. But the next time you see a headline promising broad relief for investors, ask the question this video just walked you through: relief measured in what, the number of people it touches, or the size of the dollars it moves? Those are two very different measures of fairness. And policy in Washington has a long, quiet habit of optimizing for the second one, while marketing the first. So here's the question worth sitting with. If a tax break is designed to reward people for already having money, is it really a break for investors? Or is it just a return on having arrived early?